Hi friends, in this video we will mainly learn how to pass journal entries related to balance sheet item. Now each and every transactions of the business is recorded in the form of journal entries. So let's understand how to pass journal entries related to balance sheet items. So here we go. So let's understand the balance sheet and journal entries correlation. Now let us assume that on 1st January 2025, you have started a business and introduced the share capital into the business of 5,000. So your liability side increases by 5,000 in the form of share capital. And also due to which cash balance of the business increases by 5,000. That is your asset side increases by 5,000 and thus your balance sheet tallies. Now this transaction is recorded in accounting language in the form of journal entries, for which we will make use of thumb rules. First is AID, that is asset increases debit. Then ARC, that is asset reduces credit. Then LIC, that is liability increases credit. And AID, that is liability reduces debit. Now this first transaction result into increase in cash by 5,000 and hence cash account will be debited by 5,000. The rule here is AID, that is asset increases debit. As asset is increasing, that is cash is an asset of the company, it is increasing by 5,000 and hence you will debit it. At the same time, share capital, that is liability increases by 5,000. So rule here is LIC, that is liability increases credit. Liability increases credit. So you will credit the share capital by 5,000. After that, you will write the narration of the transaction, being capital introduced in business and cash received. Now let us assume on the same date, you have taken a loan from bank due to which cash balance increases by 6,000 and bank loan which appears on the balance sheet liability side and this amount is payable to the bank. So on the balance sheet liability side, you will write 6,000 here. Now cash account will be debited here as it is increasing the asset, that is cash is increasing here and cash comes on the balance sheet asset side. So rule is AID, that is asset increases debit 6,000 and bank loan appears on the balance sheet liability side. So rule is LIC, that is liability increases credit 6,000. So being bank loan taken for business and cash received. Now let us assume on the same date you purchase a machinery for doing business. So machinery basically comes on the balance sheet asset side which increases. So you can see here balance sheet asset side machinery 2,000 and your cash to that extent reduces. So minus 2,000 and thus your balance sheet tallies. Now machinery account will be debited by 2,000 by the rule of AID, that is asset increases debit, and cash account will be credited by rule of ARC, that is asset reduces credit. ARC, asset reduces credit, as your cash balance is reducing to the extent of 2,000. Then here you write a narration being machinery purchase and cash paid. Now let us assume on 31st March 2025 you have paid some amount of loan taken from bank. Now bank loan basically appears on the balance sheet liability side and it reduces. So rule here is LRD, that is liability reduces debit. So bank loan will be debited by 500 and your cash account also reduces as you are paying the loan. So rule here is ARC, that is asset reduces credit 500. So your asset reduces, that is cash reduces by 500 and bank loan also reduces by 500 and your balance sheet tallies. Here we will write later on narration being some part of bank loan paid at year end. Thus, we have correlated journal entries and balance sheet. Thus, to conclude, what we can say is that we will make use of thumb rules, that is AID, ARC, LIC, LRD to pass the journal entries, where AID stands for asset increases debit, ARC stands for asset reduces credit, LIC stands for liability increases credit, and LRD stands for liability reduces debit.